The Fed is back to scare the market. Jerome Powell had his own speech talking about the rate hikes and how they might actually have to aggressively hike rates depending on what this data and inflation data comes in as. Because as we all know, inflation still running rampant, and it was the easy part was to go from 9% down to 6%. The hard part is going from 6% down to the normal and wanted 2% that they want. And as we know, this guy, Jerome Powell, he has enormous influence over the stock market. Whenever he just talks, which is kind of crazy that one person can influence the entirety of a $1 trillion stock market. But here we are. But some of the quotes coming out of Jerome Powell are right here. Latest economic data have come in stronger than expected and suggest that the ultimate level of interest rates is likely to be higher than previously anticipated. So that obviously kicked off the start where if you got to go higher than what you said or thought you would have to do before, obviously the market's going to be a little bit of a panic, and people are starting to price in the 50 basis point hike coming in this March meeting. They're predicting that and then kind of wavering off from there. But from all these different quotes here, even this Morgan Stanley analyst said the statement opens the door to return a 50 basis point hike at the March meeting and potentially beyond if the data flow confirms the re-acceleration in both the labor market and inflation, which both surprised to the upside in January. These guys cannot get the inflation under control. The Fed is running out of tools, right? The only tool they have is the interest rate and federal funds rate. And as we know, they keep cranking that up to try and lower demand, and maybe it lowers demand for things like housing and cars, as those loans are extremely expensive. They're at like record highs right now. Basically, any debt that you have, any debt that you get at all right now is going to be extremely expensive. That includes credit cards. And that's one of the problems coming up right now. This chart of credit card debt to personal savings is super bad. Credit card debt is almost $1 trillion, and then savings rates at like 3%. It's at like the lowest of all time. So that's not a good combination for something good to happen. That is a combination for something to break and some financial crisis to actually happen. That's going to be a side effect of all these rate hikes that are going on. Obviously, make money more expensive to borrow during a time where things are getting way more expensive to buy. A lot of people are going to their credit cards just to pay for food and basic things. As you rack that up, you get to a choice at some point where you decide, do you pay your credit card bill or do you buy food? And obviously, you're going to say, screw the credit card, and then things start to fall from there. And another quote that Powell said is this here: if the totality of the data were to indicate that faster tightening is warranted, we would be prepared to increase the pace of rate hikes. So obviously, pretty much the same thing, right? Just saying they're ready to increase rates. And for him to say that, this is kind of how the market reacted, right? He said that, and then new data, the terminal rate is up to 5.59%. And the 2024, it's just a bit lower. So people are expecting, I think, rates to kind of plateau this year and maybe start going down next year in 2025. Maybe that happens. Obviously, this is still elevated. It's not like it's really coming down, but it's still elevated. And then the stock market's response to all this, you can see this right here. The market kind of, mixed around. Nothing really crazy, right? It's not like all red. And if we go for a week, you can see it actually looks pretty good. You look at the month, not so good looking. And if we zoom out even more, 3 months, it looks all right. So the market is kind of chopping up and down. There's nothing really crazy going on with the market. It's more just reacting to the news immediately. Like the day Powell says something, the market might react and go down. But then it starts to just kind of chop around and go back up, come back down. There's no real way for the market to go. It's not going up because it's scared of what to expect, and it's not going to plummet because there's already been a plummet. The sellers have sold. The massive selling is more than likely done, so we're just kind of stuck in limbo right now. And we can see too from this chart of the market predicting, what the interest or the federal funds rate is going to be for this March meeting. 60% chance that we're going to 5% to 5.25%, which would be a 50 basis point hike or 0.5%. You got to use the fancy words in finance. And the next meeting in May, 54% chance of 5.25 to 5.5, which would be a 1/4% raise. And then the last, another 1/4% for the next meeting. And then kind of expected that 5.5 to 5.75 is the highest the rates are going to go. That's what this is probably going out for probability. This is what the market's betting on. So maybe they're right, maybe they're wrong, but this would be holding this rate for, the rest of 2023, basically 6 months of 2023, the end of it, holding that rate, and then saying that there's a chance that it comes down in 2024. Maybe if everything goes great, maybe if the inflation's tamed, but that's going to be the hard part, right? Unless some insane unemployment or insane taxes or somehow you destroy demand, that's the only way right now that the Fed can try and bring inflation down. Because after all, that's really the only thing the Fed can do, is try and make people poor so that they don't spend money. Because if you're not spending money, then the supply side, you can lower the demand and hopefully lower the prices of stuff and force prices to come down, or force prices to stay the same at least, and then inflation can come down after some time. But right now the Fed is basically probably barreling us towards a recession. There's someone from Ken Griffin, the Citadel founder, actually here said we have the setup for recession unfolding, which is kind of funny. Like, I don't know why people are saying, everyone's always like, well, maybe there's a recession coming. It looks like there's a recession coming. I mean, it definitely feels like a recession right now. Things are insanely expensive. People don't really have money. People are talking about the price of eggs when eggs went up, saying eggs are unaffordable. That's not a healthy sign of an economy. That's not something in a healthy economy that people are talking about the price of eggs and not being able to afford eggs. But there's also another sign that there's probably a pretty bad recession coming, if not we're already in one. But you can see this is the 10-year and 2-year inversion here. So when it inverts, that means the 2-year is paying more than the 10-year. And usually that leads to a recession. You can see all the way back to 1980 here. You have this inversion, recession, it came out, inverted again, you have another recession, and then stays up, inverts here, have a recession, inverts here, another recession, a little inversion, still a recession. And even this super small inversion here in 2019, like the COVID stuff, still led to even a small recession. So now you can see at the end here, we have just a plummet in this all the way down to like -1. And that is similar to the 80s. And the 80s had 2 recessions, pretty long. And basically the 80s lasted like 2 years here, 3 years of recessions. So it's not a great thing to look at this and compare, where we are now to this time back here, when that's not a very fun time. So a lot of signs are pointing to the Fed actually keeping raising rates, making, loans more expensive, making money more expensive, probably bringing the stock market down during that time too, or at least flatline, no real growth in it at least. And also barreling us towards this major recession, with all the indicators looking like something crazy is going to happen. That's going to do it for this video. As always, don't forget to smash the like button and subscribe, and I'll see you guys in my next video.